Hello, everyone. This is Ted Bauman, editor of the Bauman Daily, of the Bauman Letter, and of Profit Switch. And on that score, I just want to point out that if you'd like to check out my Profit Switch service, which is a more aggressive trading service, we've just closed out a couple of great winners, a nearly 200% gain after only 9 months in one position and 166% in another after 5 months. So despite what some people may think, I do actually invest, and I invest for gain. So if you want to play that game along with me, please click on the link and check out Profit Switch. We've got a lot more gains coming up. Let's start this week by looking at a chart of the S&P 500. This is a 10-year chart. I've drawn a trend line which shows a rough line of resistance. It's kind of the angle at which the S&P wants to rise. But look at the rise of the S&P ever since the big dip last year at the peak of the Corona crisis, the big sell-off. It's a much steeper angle, and as you can see, it has led the S&P to overshoot the long-term trend line by quite a bit. Now, to my mind, that has something to do with the pullback that we've seen this week, the weakness in the market, really over the last 2 weeks. We've seen really just the market not being prepared to put more money, particularly into the stocks that have led the way over the last decade. Now, today, what I want to talk about is what we might be looking at in the future. I want to highlight three things, three warning signs to be aware of, to look out for as the year unfolds, because they could portend a change in the direction of the market, not necessarily a correction, but certainly a rotation away from the stocks that have earned people a lot of money recently. And I'm not talking about GameStop or AMC. I'm talking about the big high PE ratio tech stocks that everybody loves. Now let's first start with some backgrounds. There's a narrative emerging from the Biden administration, act big. And what it essentially means is that whereas in the decade after the great financial crisis, we saw essentially monetary policy taking the lead and fiscal policy doing practically nothing. What Yellen wants to do is to combine the two and actually adopt a much more activist approach, where the Fed is being accommodating, but the Treasury is also spending money. That's part of the idea behind the big Biden proposal. Now, if that were to happen, that would be a pretty powerful impact on the economy and markets. So instead of that slow, grinding recovery that we saw after the great financial crisis, where monetary policy tried to boost the economy, even though it's not really designed to do that, especially under current conditions, and where we saw a bubble in the stock market, we could see a very substantial increase in both monetary and fiscal policy stimulus. Now, that could take us back to a scenario we haven't seen since World War II, which is basically the Fed trying to maintain very low rates to help the government pay off its debts. And certainly we have big ones. I'm going to come to that in a moment, but also the Treasury pumping a lot of money into the economy. Back in the 50s, we had a couple of years of nominal GDP growth of around 8 to 10%. It happened 2 or 3 times. Now, I'm not saying that this can happen now, but it certainly is possible. And if it does, what does that mean for specific sectors in the economy? Well, to understand the danger, if you like, if you're overinvested in growth stocks right now, if that scenario unfolds, let's look at a couple of different things. The first one I want to show is Treasury yields. Here's a chart that shows the 10-year Treasury yields, the constant maturity that's basically minus the 2-year. So in other words, it's showing you the gap between the two. And all other things being equal, the higher that line, it means that the higher the yield on the 10-year versus the short-term bond. Now, what we've seen is a significant uptick in Treasury yields, particularly the 10-year. Now, that's happening because investors are expecting higher inflation and higher economic growth, and when the economy begins to make a bigger return. Here's a second chart that shows the same thing. This is just the 10-year constant maturity rate. And again, this is a market set rate primarily. The Fed does intervene, but this is basically the market buying and selling bonds and determining what the yield is. As you can see, it's starting to tick up pretty substantially since its low in 2020. We're nowhere where we used to be, but it is rising. Now, the problem with rising yields is that it makes it harder to justify stretched equity evaluations, particularly for the highest priced stocks. And here's the thing. Right now, the yield on the 10-year is just edged above 1.3%. If it hits 1.5%, that means it's yielding more than the S&P 500 and the cumulative average yield of the whole index. And that means that people are going to start reconsidering whether it's worth being overexposed to equities rather to bonds. And that could lead them to do two things. One is maybe to pull out of the stock market for a breather, go into bonds and let them compound, take advantage of the slightly higher rates, or simply rotate away from stocks that are relatively less valued than they were when the interest rates were lower. Now, why does that matter? Well, here's a chart that shows the S&P 500, the highest yielding stocks in the S&P 500, that is the orange line, versus the 30-year Treasury yield. Now, as you see, there's definitely an inverse relationship between those two. With some short-term exceptions, like the Great Financial Crisis, as those long-term yields fall, the stock market rises, particularly the very highest PE stocks. And that's logical because basically, if you have a very low yield on the Treasury, the net present value of future earnings of companies that are in growth mode becomes very much higher, almost infinite in a sense. And so you begin to justify investing over the longer and longer term. Now, what that means is that if we were to hit that 1.5% Treasury yield, I think that we could actually begin to see a significant pullback in that. And that could lead to a shift away from the high-flying stocks and indexes like the NASDAQ 100 and a shift more towards cyclicals and value stocks. Now, obviously, if the stock market is performing, or rather if the economy is performing well thanks to stimulus and the retreat of COVID, then you would expect that the stocks that are consumer facing would begin to do better and the relative returns would be better. But having higher yields on Treasury bonds means that that is reinforced because investors are looking basically to pull away from the growth stocks because of the mathematics of how the future gains work out. And that could lead to a significant pullback in all the darlings that we've invested in over the last year. Now, second point. Corporate bond yields. Right now, financial markets have taken it as a given that the Fed's accommodative policy stance, where they say that they're going to let the economy run hot until we have sustained 2% inflation, and also to try to get employment up. That means that the bond markets are taking it as a given that there'll be plenty of money around to chase after debt and to buy debt instruments. Now, the problem is that if that were to be challenged in any way, that if we saw corporate debt yields begin to rise, or rather the spread between corporate debt yields and the Treasury bonds begin to rise. In other words, people were backing away from corporate debt, particularly high yield debt, and focusing on Treasuries instead, then you could see a lot of trouble in the market because it would mean that companies would have a harder time raising money. There's a lot of stress on particularly lower tier companies that are struggling to really recover from the pandemic, particularly in service sectors. So essentially what the danger is here, that you could end up in a situation where yields begin to rise. Now here's a chart, or rather yield spreads. Here's a chart that shows yield spreads. This is the effective yield on a high yield bonds. This is essentially the triple C, triple B type bonds. Now, they are at historical lows. That's the far right-hand side of the chart, but they could easily go a lot higher. In fact, they were a lot higher at the beginning of 2020. They've fallen because of the Fed's activities. And as we know, the Fed actually withdrew its bond buying facility, which it didn't use very much, but that has sent a message to the markets that the corporate bond market is not its real priority. But look at the historical levels. I mean, if we were to get back up to yields in the neighborhood of 7.5%, 8%, which is not historically unprecedented, that could spell serious trouble for certain parts of the market, and that in turn would put pressure on stocks in that part of the market. Now, the problem is, in addition to the fact that there are vulnerable companies, instead of deleveraging during the COVID pullback, as is typical with recessions, instead companies have loaded up on debt at these low interest rates. And so if interest rates begin to rise on corporate debt, that puts huge pressure on them, because not only are they paying more on debt, but they have more of it to pay on. Now, private sector non-financial debt increased by 9.5% last year. And essentially that is the highest. If you take it over a 10-year average period, that's the highest growth rate relative to GDP in the last decade. In fact, we've had a 15% growth in the ratio of debt to GDP over the last decade. So let me show you the chart that shows that. You can see that it's been rising. It fell after 2000. It was ticked up a little bit during the great financial crisis, but look at that spike in 2020. Huge spike in debt, non-financial corporate debt, and that is as a percentage of GDP. We've now got to the point where not just in the United States, but around the world, non-financial private sector debt, corporate debt primarily, makes up 165% of world GDP. So it's 65% higher than world GDP by value. So in that context, it's pretty hard to justify continuing extremely low yields on risky corporate debt. So that's the second thing that you want to watch out for, in addition to the potential for bond yields, Treasury bond yields, to exceed 1.5%. If we start to see those debt yields expand, if we start to see the yield on corporate debt go back to the 8, 9, maybe even 10% range, that could put a lot of pressure on the stock market. The third thing is the status of the US dollar. Now, generally speaking, a weaker dollar is better for US stocks because it means that they're cheaper from an exchange rate perspective for foreign investors. It leads more money into the US economy and into the US stock market. The problem is that the outperformance of the US stock market over the years has led to an increasing strength in the dollar. People are pouring into US dollar denominated assets, and that has led to an increase in the value of the dollar. Now, here's a chart that shows the long-term trend. You can see that the dollar spiked during the great financial crisis. As people fled to safety, then it pulled back. It started to pull up pretty significantly in 2015 and really kind of achieved a pretty good high, a little bit of a dip around the transition period during 2016. There were some things going on in China. There was the U.S. election. But generally, the value of the U.S. dollar relative to other currencies, it peaked at the beginning of 2020, again in reaction to crisis. Then it's begun to decline. But look at the far right-hand side. There's a bit of an uptick happening again. Now, the problem with that is that if we do see a strengthening of the U.S. dollar, then again, that puts pressure on the U.S. economy. It means that it's much more difficult for U.S. exporters to be competitive. It means that U.S. stocks become overpriced in dollar terms or in terms of other currencies relative to the dollar. It means all other things being equal, people are going to pull out of the U.S. stock market. So my basic message is these are three things to look out for this year. Keep these indicators on your watch list. One is the 10-year Treasury yield. If it gets to 1.5%, that's a critical turning point. It could have a significant impact, particularly on the stocks that have done well over the last year. Second thing is to watch the spreads in corporate debt. If they begin to rise again, that could signal a lot of trouble again in the stock market. It could lead to a withdrawal of liquidity from the stock market as investors really try to shore up their positions relative to their exposure to corporate debt. And the third thing is that we want the dollar to weaken because it's going to be good for our stock market and for our economy. The problem is that right now we are headed towards what looks like a very strong economy thanks to all the stimulus, and that could paradoxically actually undermine the performance, particularly of those highest flying stocks. So the overall message today is we've had a great run with the big technology stocks, the high PE stocks, but they are starting to turn. I'm not saying that they're not going to recover temporarily. No dip ever happens all at once. But there are strong indications that if the economy strengthens, it's going to make other stocks relatively more appealing. And that could spell lots of trouble if you're invested in stocks that have PE ratios of 100, 200, 300, 400, over 1,000. Like an EV maker that we know. Bottom line is keep an eye on those ratios, folks. That's what I'm doing. That's what we do at the Bauman Letter and at Profit Switch. Take care. Have a good week, and I'll talk to you again next week. And please don't forget, consider adopting Profit Switch as one of your portfolios. I know I keep a close eye on it for everybody. Take care. I'll talk to you next week. Bye-bye.